Welcome to the Credit and Traditional Loans module, which is part of the financing course. A traditional loan is an important financial decision in the lives of most people, yet most people don't understand the various terms and concepts associated with applying for mortgages, associated fees, and obtaining a mortgage. If you are considering applying for a traditional loan, it behooves you to spend some time educating yourself about their process, terms, and consequences. In this guide, we will introduce how credit is calculated and weighted by a lender when they are qualifying you for a loan. We will discuss how to improve your credit, the different types of loans available, as well as the government loan programs for investors. We also discuss the laws involved with lending and what to watch out for when shopping for a loan, as well as the paperwork required to apply for a conventional loan. The laws and availability of loans may change from time to time, so you will want to stay abreast of these changes if you are going to pursue traditional lending for your investment properties. What you should know. Before beginning this guide, you should understand basic principles and terminology used in real estate investing. Which properties to look for and why. Where you want to buy real estate. How to locate motivated sellers. Basic understanding of financing. What you will learn. This guide covers the following learning objectives. Understand your FICO, what affects it. Explain what improves a credit score. Know the relationship between credit and mortgages. Explain terms related to loan shopping. Explain how a lender secures a loan. Understand disclosures and lender laws. Explain what can vary in a loan. List the types of loans. List the types of loans programs. Summarize the refinancing process. Understand general loan application paperwork. Explain general conventional loan qualification ratios. Tips for success. Many first-time home buyers find they get more than they bargained for when applying for a loan. Completing the paperwork and trying to improve their credit score can be a tremendous effort. Going into a loan application blind can be detrimental to qualifying for a loan. All of the following factors ultimately determine if your finance application is approved or denied. Just because you make a good income doesn't erase other negative marks on your credit report. So, here are some tips as to what lenders are looking for on a loan application. Tip number 1, adequacy. Mortgage lenders want to make certain that you can make loan payments each month. Your income will largely affect this part of the process. Lenders also want to be sure that you can pay all of your property taxes and homeowners insurance policies. Tip number 2, track record. Mortgage lenders obviously want to know how you paid your debts in the past. This is where your credit score and credit history report come into play. By working to improve your credit prior to applying for your mortgage, you may stand a better chance of demonstrating a successful track record. Tip number 3, collateral. Your prospective new home will require an appraisal that will assess the value of the home and relative to the agreed upon purchase price. Tip number 4, equity. The mortgage lender will consider the amount you put towards the down payment of the home. Based on the purchase price of your home, the higher your down payment, the more favorable your loan application will appear. Your FICO credit score explained. If you recall, in the financing lesson of the Real Estate Basics course, we introduced and explained what a Fair Isaac Credit Organization credit score was. FICO is the pioneer in consumer credit scoring, and even though there are other proprietary credit scoring systems, it is the standard banks, businesses, and employers use to evaluate borrowers, consumers, and employees. Your credit score is a number between 300 and 850 and is obtainable from the credit reporting bureaus, Equifax, Experian, and TransUnion, the major U.S. credit reporting agencies. A 3-in-1 or tri-merge report will pull your score from all three of these agencies. If you have had 60 and 90-day late payments on your credit report, your score drops. Foreclosures, bankruptcies, and collections affect your score very badly as well. Credit Bureau reports effect on your FICO score and mortgage. Your mortgage terms are incredibly dependent on your FICO score. If you want to get a conventional loan, you want the highest credit score possible so you can get the lowest interest rate and qualify for the most loan options. A score over 700 will get you very nice rates. A score below 620 is considered subprime and you will not get a good loan. The higher your credit score, the more options you have to obtain credit with a low interest rate. The lower your credit score, the higher risk you are perceived to be and the fewer options you have to acquire credit, let alone for a decent interest rate. Vantage Score Credit Rating. You may hear occasionally about Vantage Score, so we want to introduce how it varies from the FICO score. Vantage Score was introduced by the three major credit reporting agencies in 2006. Their Vantage Score reports are available for $5.95 each, a fraction of the cost of the FICO score. However, the scores are not a direct substitute for each other, and mortgage lenders continue to look at FICO scores when reviewing mortgage applications, so they are the scores a mortgage borrower should review. This credit score model ranges from 501 to 990 and also assigns letters from A to F to the different credit score ranges, as shown by the following table. Factors beyond credit scores. While scores are important, they are not the only thing lenders take into consideration when approving a mortgage. Other offsetting factors can balance a low credit score, such as a large down payment, large cash reserves, or an overall low debt-to-income ratio. Don't assume that you can't get a mortgage because of a low credit score, or limit your loan search to lenders that specialize in loans to people with troubled credit. Instead, look for a lender who does not charge a fee to take your application and qualify you for a loan. What affects your FICO? As we mentioned earlier, late payments, foreclosures, and bankruptcies all affect your credit score. Information used for credit score calculation. Here is what exactly is reported to the credit agencies and how it is weighed to form the credit scores. Recent payment history, last 12 months. This has the greatest weight. Punctuality of payment, 35% of your FICO score is based on your payment history. Reoccurring late payments are very bad in terms of FICO. Having foreclosure or bankruptcy on the record may get you a 100 points drop in the FICO score. Credit cards, rent, mortgage, or car loan payments. Bankruptcies, foreclosures, tax liens, and judgments. Credit balance. This refers to debt to credit balance, that is, having maxed out credit cards is bad. Having many credit cards with little debt is better than having 2 or 3 close to the limit. Pay off credit card debt and stay below half the limit to improve your score. Amount of debt. Your debt will count as 30% towards your FICO score. Oddly, it turns out that closing old accounts negatively affects your score, while having many accounts with a small balance keeps it up. Credit history length. The longer your credit history, the higher your score. Your credit history counts as much as 15% towards the FICO score. Lenders appreciate people with significant credit history. New credit and loan applications, another 10% will go to your loan applications. If multiple lender requests show you have been looking for more credit, possibly more than you could carry, your FICO score may be hurt. Types of credit. The types of credit you use account for 10% of your FICO score. If you show ability to handle both secured and unsecured debt, your FICO will be positively affected. That is, you need to pay a mortgage, and not rent, to maximize your credit score, as well as carry and pay small balances on your credit cards. Too many simultaneously pulled soft credit score pulls, made by you, or your employer and lenders with or without your consent, can reduce your score, as they signify to creditors that you are shopping for too much new credit. Too many credit cards or newly opened accounts also affect negatively credit score calculation. Employment history and marital status. The more stable you are, the higher your score. Your age. The older you are, the higher your score. Your current address. Your score can be affected by where you live. If you are on a social benefit program, your score can be negatively affected as well. Improving your credit score. If you have bad credit score, you need to improve it as soon as possible. The truth is, increasing credit score takes time and effort, and there are no quick fixes. Keep debt low. First, you need to keep your debt low. If you have credit card debt that you can afford to repay, you'd better pay it. Also, if a credit card balance is approaching the limit, either increase the limit or transfer part of the balance to another credit card, as exhausting a credit card limit negatively affects your score. Bring payments up to date. Another thing to take care of when trying to increase credit score is bringing your late payments up to date. Late payments hurt your score severely. If you have a 600 credit score, you mainly need to clear up 90 and 60-day late payments. Take on a new small loan. Since credit history does matter, taking on another loan you can afford while trying to increase credit rating score makes sense. This will help your score in a very short time. Once your credit is back to normal or close, you could refinance out and take a conventional loan instead. Minimize credit inquiries. Another thing you need to do is restrict or minimize the number of inquiries you have within any given time for new credit. The more inquiries you have, the more hits there are on your credit. Spread debt around. You also need to reduce the amount of credit you have used on any one credit line, so it is preferably less than half of that line of credit being used at any given time. Financial advisors usually recommend paying off the credit lines that have the highest interest rates first, and we recommend that approach if you also use the interest savings to pay down your closest to the limit debts. View your credit report. To really improve your credit rating, look over your credit report and look for any problems or inaccurate information and rectify them with the credit bureau reporting it. Since not every company reports to Equifax, Experian, and TransUnion at the same time, your scores will differ, as will your records. Improving credit rating score does take time, so if you are going to apply for a mortgage, you will need some time to challenge obsolete credit records, achieve a much better score, and qualify for decent rates. Don't close revolving lines of credit. Closing a revolving line account will never improve a FICO score, and in some cases can harm it. Although some advisors say that closing installment loans can help improve your credit score. By closing one or two of these credit accounts, without reducing your overall borrowing, boosts your ratio of indebtedness compared to the total amount of credit available. Lenders prefer to see that you have lots of credit available but relatively little of it actually borrowed. How lenders determine your mortgage rate. This module discusses how your local lender or bank determines the rate for your specific home loan. There are really two pieces to mortgage rates. First, there is a general market price for loans. This is how Wall Street and the open market prices mortgage-backed bonds. Second, your local lender mortgage broker takes the Wall Street open market rates and then offers them to the public. Assume that today's market price for a loan is 6.5%. In order to get this 6.5% loan, you must meet these qualifications. Put 20% down. Have a credit score of at least 700. Property being purchased must be owner-occupied, and condominiums must be at least 50% owner-occupied tenants, not renters. Have 3 months savings in an account, or have 3 months worth of payments in the bank. Document all income with tax returns and/or a W-2. Debt-to-income ratio, DTI or DR, must not exceed 45%. Have an escrow account so the bank, not the individual, pays the taxes and insurance. If you meet all these guidelines, then your rate would be 6.5% for a 30-year fixed rate. Naturally, if the borrower wanted a 15-year mortgage, the rate would be lower since 15-year rates are lower than 30, but you would still have to meet these guidelines. Risk determines rate. Remember, the risk of the loan determines the final rate. Every time one adds a higher element of risk to their loan, like putting down less than 20% or not having a 700 credit score, the banks charge higher rates, just like insurance companies charge higher premiums if they know a proposed client has less than stellar physical health. However, since not every borrower can put 20% down, the banks charge a higher rate. Rate hits not all bad. Not every rate hit is a bad thing. Sometimes banks charge more for higher risk loans even if the borrower has stellar credit and debt ratios. If the client wants to reduce his or her closing costs and waive escrows, pay his own taxes and insurance, the bank will typically charge a 0.25% higher rate. They do this because when one waives escrow, they are opening the bank up to a potential tax lien should the borrower fail to pay his property taxes. Another example of a good rate hit is when someone eliminates private mortgage insurance, PMI. Banks charge higher rates because banks prefer lending on homes that are protected with PMI. If the borrower fails to pay his mortgage, the PMI company stands behind the bank's investment. Loan components and terms. Many different factors can increase or decrease the cost to borrow money, such annual percentage rate, APR, loan origination costs, and private mortgage insurance, PMI. Your APR will dictate how much the loan will cost you over the term of the loan. There are different ways that it can be calculated, so it is in your best interest to understand these basics, so you understand how much you will be paying each month as well as for the lifetime of the loan. The loan origination fees should be considered too, as if they do not require it up front, it might cost you more money in the long term. Private mortgage insurance is an extra monthly cost that may be required by certain lenders based on your level of credit risk and amount of money you are putting down. Annual percentage rate, APR. The annual percentage rate that you hear so much about allows you to make true comparisons of the actual costs of loans. The APR is the average annual finance charge, which includes fees and other loan costs, divided by the amount borrowed. It is expressed as an annual percentage rate, hence its name. The APR will be slightly higher than the interest rate the lender is charging because it includes all, or most, of the other fees that the loan carries with it, such as the origination fee, points, PMI premiums, etc. Origination fee. If a lender charges an application fee of $45 and an origination fee of 3% paid in cash at closing, the total of those fees, $3,820, is deducted from the actual loan amount of $100,000. $100,000 minus $3,820 equals $96,180. To find the APR, determine the interest rate that would equate to $664.30 for a loan amount of $96,180, which in this case is 7.39%. Although the lender advertised no points, because it charged an origination fee, it didn't really offer the best deal. When you evaluate loans, make sure you know which fees are being included in the APR calculation. You don't have to calculate the APR on your own, the lender will give it to you when it gives you the federal truth in lending disclosure, you just have to understand its importance. Here are some other things to take into account when you look at the APR impact of financing. The more you are financing, the less impact all of those fees will have on the APR, simply because the APR is calculated based on the total loan amount. Length of time in the home. The length of time you are actually in the home before you sell or refinance has a direct influence on the effective interest rate you ultimately pay. For example, if you move or refinance after 3 years instead of 30, after having paid 2 points at the loan closing, your effective interest rate for the loan is much higher than if you remain in the home for the full term. How lenders secure loans. Whenever a loan is used to purchase a house, the bank creates a security, which enables the bank to secure the repayment of the loan if the borrower defaults. For housing loans, banks accept the home being mortgaged as security, provided the value of the home is sufficient to cover the loan. Sometimes, banks allow cross-collateralization, wherein the borrower uses another property as collateral for the loan, when the value of the property being purchased is insufficient to cover the amount borrowed. Normally, banks and financial institutions prefer to have the first lien position on the property if the purchaser defaults on a loan, so they can have the first right to foreclose and recoup their money. Private mortgage insurance. Private mortgage insurance, PMI, is insurance that pays the mortgage in the event that you can't if you default on the loan. PMI is protection for the lender who is taking a greater risk with a borrower who has less equity. PMI can help you get into the home you want by enabling you to pay less than the typical 20% down payment. This is particularly helpful for younger buyers who don't have the years to save but want to enjoy the benefits of home ownership. Lenders have discovered that there is a definite correlation between the amount of money a borrower puts into the home and the rate of default on loans. The more money put down by the borrower, the lower the rate of default. Example. Here is an example of how it works. If a couple has $10,000 in the bank, then they can buy a $50,000 home if they have to pay a 20% down payment. If they don't have to pay 20%, then that same $10,000 can be a 10% down payment on a $100,000 house or a 5% down payment on a $200,000 house. If they opt for the more expensive house, however, they have to pay for PMI. The costs for PMI are based on the loan amount. For a $100,000 loan with a 10% down payment, the average cost of PMI might be $40 per month. In 1998, the Homeowners Protection Act established rules for mortgages signed on or after July 29, 1999, that require the automatic termination of PMI after you have reached 22% equity in the home, based on the original property value. You can drop PMI when you reach 20% equity if your mortgage was signed after that date. If your mortgage was signed prior to that date, you can request the cancellation of PMI once you've reached the magic 20% mark, but your lender isn't required by law to cancel it. There are certain conditions that may make your loan an exception to this rule. For example, if you haven't kept your payments current, if your loan is considered a high risk, or if you have other liens on the property. There are some states that have laws regarding early termination of PMI for those who sign mortgages before July 29, 1998. Loan variables. Loans vary depending on the borrower, type of property, and current lending practices. When investor confidence is strong and there is a lot of money in the economy to lend, more creative and flexible loans are available. Likewise, the reverse will limit the availability of programs and terms offered by those programs. Years. The number of years that a loan can be offered can vary based on credit, monthly payment ability, type of property, location, and loan programs offering it. You may at any given time find loan terms offered from 5, 10, 15, 20, 30, 40, and 50 years. In some cases, the amount you pay per month might change at certain predetermined intervals because of ARMs, options, or balloons. Payment terms. How and when payments are made depends on the payment terms. For instance, the payment per month could be interest only, or amortized, or it could balloon at a predetermined time. If it is an interest-only payment, then only interest is being paid on the loan, so the principal amount will not change. The amortized loan payment allows the borrower to pay interest and principal at the same time. Generally, borrowers pay more interest at first than principal. Eventually, depending on the term of the loan, they will pay more principal than interest as they get closer to the end of the loan term. In the case of a balloon payments, the borrower makes up to a certain point and then the remaining balance of the loan becomes due and they will need to pay off the loan in full. Loans can balloon at years 3, 5, or 7. For fixed-rate mortgages, FRM, the payment amount stays the same throughout the loan. For adjustable rate mortgages, ARMs, the rate can adjust at some specified point to an amount that could then vary each month. Some loans allow the borrower choices. They can pay an adjustable or fixed rate, or a variety of different options could be offered depending on the loan program. Buy-down interest rate option. A mortgage buy-down is an initial lump sum payment by the borrower that enables the lender to temporarily, usually 1 to 3 years, lower the interest rate on a fixed-rate mortgage to facilitate the sale of a property. Payments may or may not increase at the end of the stated period. How a buy-down works. In this mortgage financing technique, the builder and/or seller of the home typically provides payments to the mortgage lending institution. The lending institution, in turn, lowers the purchaser's monthly interest rate on the mortgage and charges a lower monthly payment. The price of the home is increased to compensate the home seller for the costs of the buy-down arrangement. There are 2 types of buy-down mortgages. 1. Temporary buy-down. A temporary buy-down mortgage is one in which a payment is made to reduce the borrower's monthly payments during the first few years of a mortgage. After the first few years, and for the remainder of the term, the borrower must pay the original note rate. 2. Permanent buy-down. A permanent buy-down is an upfront payment that reduces the interest rate over the lifetime of a mortgage. The most popular buy-down is the 2-1 buy-down, in which the buyer's mortgage interest rate is 2% below the negotiated rate the first year of the mortgage loan, 1% below the negotiated mortgage interest rate the second year of the mortgage loan, and at the negotiated rate the third year of the mortgage loan and thereafter, if it is a 30-year fixed-rate loan term. An example. Let's take a 30-year fixed-rate mortgage loan of $400,000 at 6.25%. Using the 2-1 buy-down, your mortgage payment would be: first year at 4.25% interest equals $1,968 principal and interest. Second year at 5.25% interest equals $2,209 principal and interest. Third year at 6.25% interest equals $2,463 principal and interest. This buy-down option would probably cost the seller $8,988. However, spending $8,988 is less than dropping the home's price by $10,000 to $20,000 in order to qualify and attract more buyers. Types of loans. This module covers different types of loans that lenders offer. If you recall, in the financing lesson of the Real Estate Basics course, we introduced all of the different lending institutions as well as people who could help you get a conventional loan. So if you are not quite sure as to what these options are, we recommend reviewing this lesson again. Fixed-rate mortgages, FRM. Fixed-rate mortgages, FRMs, are the most common and the simplest type. A FRM maintains the same interest rate throughout the life of the loan and is great for those who anticipate keeping their houses for the foreseeable future, prefer to avoid risk, and don't expect any major increase in income. FRMs are the first choice of many risk-averse borrowers. If they can afford to, borrowers can make additional principal payments to accrue equity faster, retire the loan sooner, and pay less interest. Types of FRMs. There are several varieties of fixed-rate loan available besides the most common, which is the 30-year fixed. Also available are 5-year fixed, 10-year fixed, 15-year fixed, 20-year fixed, 25-year and, on occasion, 40-year fixed, which may be making a comeback. Shorter-term FRMs. The shorter the term of the FRM, the lower the interest rate generally is, as lenders are not only guaranteeing the rate will not change for a lesser period, but due to the shorter the term, the borrower is paying more principal monthly, making the loan less risky. Nonetheless, shorter-term FRMs are harder to qualify for because the minimum payment is higher. They also take less advantage of leverage, although this is always a two-edged sword. They will offer an amortized repayment schedule that will apply interest and payment to a set monthly payment amount. The monthly payment will apply to interest more in the beginning of the loan, and then it will slowly decrease and more of the monthly payment amount will cover principal. Both interest and principal will be paid for the lifetime of the loan, but the amount applied will vary based on the point in the loan you are at. Sensible loan. During periods of historically low interest rates, they might be the most sensible mortgage loans available. For borrowers who want a lower payment but are uncomfortable with adjustable rate mortgage (ARM) options, lenders have come up with fixed rate mortgages with 40 or even 50-year terms. Although longer terms mean more interest paid over the life of the loan, the lower payments may help borrowers comfortably afford a home without taking a chance on an ARM or interest-only loan. Advantages. Fixed-rate mortgage payments are easier to budget for because the payment and rate never change. They are fully amortized, so homeowners gain equity even if their home's value doesn't increase rapidly. Disadvantages. Interest rates are typically higher than an ARM's introductory rate. When interest rates drop, borrowers must refinance their mortgage to improve their rate. It won't automatically decrease like it can with an ARM. The possibility of rates moving lower while the homeowner is stuck in a 30-year FRM is called interest rate risk by economists. 15-year FRM. Like a 30-year fixed-rate mortgage, a 15-year FRM carries an unchanging interest rate and monthly payment throughout the life of the loan, this time, 180 months. Rates for 15-year mortgages are approximately 0.5% lower than rates for 30-year programs. Typically, borrowers who choose a 15-year fixed-rate program over a 30-year fixed-rate program can make a higher payment and want that lower interest rate. The shorter term might also be a fundamental part of a retirement plan, eliminating the house payment before leaving the workforce. Advantages. The 15-year fixed-rate mortgage offers many advantages, among them a lower interest rate. Equity accrues much faster than it does with a 30-year loan, greatly reducing the chance that the borrower will ever be upside down on the home, owing more than the property is worth. The cushion of equity acts as a financial safety net in case of unexpected financial needs. The 15-year fixed-rate loan, like its 30-year counterpart, offers safety in the event of interest rate increases. Budgeting is easier and those with fixed incomes needn't worry about their loan payment changing and becoming unaffordable. Disadvantages. Despite the lower rate, 15-year fixed-rate mortgage payments are considerably higher than those of loans amortized over 30 years. A homeowner with a 30-year loan can choose to pay more when he or she can afford it. A borrower with a 15-year loan doesn't have that choice. If money gets tight, the higher mortgage payment will still be required. Also, like a 30-year FRM, the interest rate doesn't drop when rates go down. Borrowers with FRMs have to refinance to take advantage of drops in interest rates. The 15-year FRM is extremely suitable for borrowers who don't want to be at the mercy of the financial markets, especially homeowners with fixed incomes. Those who plan to keep their homes indefinitely and can afford the higher payment of a 15-year mortgage may find that this loan meshes best with their financial and lifestyle plans. 30-year FRM. The 30-year fixed-rate mortgage offers maximum stability and safety, particularly for those who don't anticipate substantial increases in income. Its interest rate and monthly payment are fixed throughout the life of the loan, 360 months. A 30-year FRM is one of the most popular of all of the residential mortgage products and is available in conventional, jumbo, also called non-conforming, loans, and FHA and VA mortgages. Advantages. This loan makes it easier to budget living expenses because the payment and rate never change. The loan is fully amortized, so borrowers accrue equity even if their house's value doesn't increase rapidly. Disadvantages. Interest rates are higher than an ARM's introductory rate, and if interest rates go down, borrowers must refinance to get a better rate. The possibility of rates dropping while the borrower is stuck in a 30-year FRM is referred to as interest rate risk by economists. The 30-year FRM is a great loan for those who plan to stay in their homes a long time, are risk-averse, or live on a relatively fixed income. And if they end up earning more money than expected, homeowners can always make additional principal payments whenever they want, accruing equity faster and saving thousands in interest over the life of the loan. 40 to 50-year FRM. Increasing home prices in some areas have created a need to make mortgage payments more manageable. While these extra long-term fixed-rate mortgages aren't for everyone, a fixed-rate loan with lower payments than traditional 30-year fixed loan programs can help borrowers stretch their incomes to qualify for just a bit more house than they could otherwise afford. However, these 40 and 50-year mortgages are not the best loan option for most borrowers. Most people change properties every few years. For them, the savings afforded by the lower rates of hybrid ARMs provides a better way to lower their payments, and the 30-year amortization helps them accrue equity faster. Advantages. For some buyers, the difference in a 40-year payment and a 30-year payment could be the difference between being approved or declined for their mortgage. If they don't intend to sell the property in the foreseeable future, don't anticipate a significant income increase, and are really uncomfortable with an ARM, long-term fixed-rate mortgages can help the buyers get their home and sleep at night, too. Disadvantages. Adding 10 or 20 years to a mortgage means paying a lot more interest over the life of the loan. It also dramatically slows the accrual of equity. The difference in the 40-year payment and 30-year payment isn't usually dramatic enough to justify the added interest expense. Adjustable rate mortgages, ARM. An adjustable rate mortgage, ARM, has an interest rate that changes based on changing market rates and economic trends. ARMs usually offer an initial interest rate that is 2 to 3 percentage points lower than fixed-rate mortgages, but they don't offer the stability or assurance of a known mortgage payment. If you don't expect to be in your home for many years, however, an ARM may be just what you need. How often your interest rate adjusts is determined by the terms of the loan. Types of ARMs. You can choose a 6-month ARM, a 1-year ARM, a 2-year ARM, or some other term. There is usually an initial period of time during which the rate won't change. This might be anywhere from 6 months to several years. For example, a 1-year ARM would mean the initial interest rate would stay the same for the first 5 years and then would adjust each year beginning with the 6th year. A 3-year ARM would mean the initial interest rate would stay the same for the first 3 years and then would adjust every 3 years beginning with the 4th year. Caps. There will also be caps or limits to how high your interest rate can go over the life of the loan and how much it may change with each adjustment. Interim or periodic caps dictate how much the interest rate may rise with each adjustment. For example, the terms of the loan may be that the rate can go up as high as 1 percentage point each year, depending on the market. Lifetime caps specify how high the rate can go over the life of the loan. For example, the terms of the loan might specify that the rate cannot go up by more than a total of 6 percentage points. The interest rates for ARMs can be tied to 1-year U.S. Treasury bills, certificates of deposit, the London Interbank Offer Rate, or other indexes. When mortgage lenders come up with their rates for ARMs, they look at the index and add a margin of 2 to 4 percentage points. Being tied to these index rates means that when those rates go up, your interest goes up with it. The flip side is that if they go down, your rate also goes down. Hybrid ARM advantages. Borrowers with ARM loans benefit when rates drop because their mortgage rates fall as well. There's no need to refinance. The lower initial rate can also help borrowers beginning their careers, letting them skip the starter home and buy a better house right away. The hope is that by the time the loan adjusts with possibly higher payments, the borrower's income will have increased as well. Others take ARMs because they know they will sell the home before the loan's introductory period ends and the loan readjusts. Some borrowers opt for ARMs to reduce the mortgage payment and temporarily free up cash for other investments. For example, someone starting a new business might want a lower house payment while the new company gets off the ground. Another good use of an ARM loan is to accelerate paying down the mortgage and accrue equity faster. By applying the difference between a 30-year fixed loan payment and the lower ARM payment to the principal balance each month, the homeowner can build equity faster and create a financial safety net. ARMs come with a wide range of features to suit the varying needs of borrowers, and they are not always easy to understand. The Federal Reserve has created a booklet called the Consumer Handbook on Adjustable Rate Mortgages that the lender can provide. It is also available online on the Federal Reserve website. The provisions of an individual loan are found on the Adjustable Rate Rider Disclosure and on the Truth in Lending Disclosure. ARMs are powerful financing tools when taken for the right reasons and with full understanding. Disadvantages. Like fixed-rate mortgages, ARMs also carry interest rate risk. For fixed-rate borrowers, the risk is that market rates will go down while their mortgage rate will stay up. For adjustable-rate borrowers, the risk is that market rates will increase and so will their mortgage rate. ARM borrowers can find themselves in trouble if rates go up. This risk is greater for borrowers with little equity who may be unable to refinance to a new loan or sell the property because they owe too much. The homeowners risk home foreclosure and badly damaged credit as well. A hybrid ARM is simply a combination of an ARM and an FRM. This popular loan choice features an introductory period in which the rate is fixed. Generally, the shorter the fixed rate period selected, the lower the rate. Most loans offer introductory fixed rates for the first 3, 5, 7, or 10 years of the loan. At the end of the introductory period, the new rate is calculated the same way as a regular ARM loan, using a published financial index plus a margin agreed to by the lender and borrower. This is called the fully indexed rate. Like regular ARM loans, hybrid ARMs. Option ARM come with adjustment rate caps and lifetime rate caps. The difference is that there may be an additional cap, the first adjustment cap. For example, if a borrower selected a 3-1 hybrid ARM loan with a start rate of 4%, the rate would be fixed at 4% for the first 3 years, then the loan would convert to a 1-year ARM and adjust once a year. The first adjustment would be determined by the index, for example, the 1-year constant maturity treasury, or CMT, in this case assume it is at 2.71%, plus the lender's margin, assume in this example that it is 2.5%. So this loan would adjust from 4% to 5.21%, 2.5% plus 2.71%. Typically, a first adjustment cap for a hybrid ARM is 3%. So if the CMT happened to be at 6% instead of 2.71%, the rate would not jump to 8.5%, the 3% cap would limit the new rate to 7%. The rate on this loan could be adjusted each year, and the cap for these subsequent adjustments is usually 2%. In addition, hybrid ARMs come with lifetime caps. A lifetime cap of 5% means that this loan rate could never exceed 9%, the starting rate of 4% plus cap of 5%, regardless of what the CMT does. Advantages. The loan offers a discount from 30-year fixed mortgage rates while providing a safety net of a fixed rate for the introductory period. And for many homeowners, it makes little sense to pay for a fixed rate for 30 years when most will be out of their homes long before then. In addition, borrowers seeking jumbo loans find that hybrid ARMs offer them significant savings over 30-year fixed-rate loans. Jumbo hybrid ARM rates are generally lower than comparable ARMs in conforming loan amounts. Hybrid ARMs provide a combination of safety and savings that many homeowners find too attractive to pass up. Disadvantages. This loan could be described as offering the best of both worlds or the worst of both worlds. If rates increase when the fixed rate period is over, the borrower could end up with significantly higher payments. And if rates drop while the borrower is in the fixed rate period, he or she would be unable to take advantage of that lower rate. So if the fixed rate period is too short in an increasing market, or too long in a decreasing one, borrowers could find themselves on the wrong side of a rate rebound. An option ARM is an adjustable rate mortgage with a twist. It offers the lower interest rate benefit of a standard adjustable rate mortgage while allowing borrowers to choose how much they want to pay each month, from minimum payments as low as 1% to interest-only payments, fully amortized 30-year payments, or accelerated 15-year payments. Borrowers can tailor their payments to accommodate economic necessities and lifestyle choices as they manage their mortgages. The option arm allows using equity in the home to keep the payments low. If rates drop or the borrower's income increases, they can accelerate the payoff with a 15-year amortized payment. Those expecting a windfall like an inheritance or legal settlement can choose to pay down the balance. Some lenders will even recalculate or recast the loan, changing all four payment amounts based on the new balance. Enhancements. Other available enhancements are 40-year terms and no income verification (NIV) options. The 40-year amortization lowers the fully amortized payment and may add a layer of safety for borrowers. NIV means no income verification is required, and it is used when borrowers' incomes are hard to verify, i.e., self-employed people or those with complicated finances they prefer to keep private. Caps are among the most important features of an option arm. Most loans have rate caps, and lower caps are better than higher caps. Option arm caps come in two guises: payment caps and lifetime rate caps. The payment cap, generally 7.5%, kicks in each year when the minimum payment is adjusted upwards. For example, a $300,000 loan with a 1% minimum payment rate would begin with minimum monthly payments of $758.57. After a year, the payment would adjust a maximum of 7.5% to $815.46, and the next year to $876.62. This protects borrowers from sudden, perhaps unaffordable increases. Lifetime caps. The lifetime rate cap, or ceiling, is usually expressed as a maximum rate and can vary from 9% to 19%, depending on financial markets at the time the loan is taken out. Knowing the maximum loan rate helps borrowers plan accordingly. Advantages. Option arms are considered sophisticated instruments that should not be jumped into lightly. They benefit borrowers who intentionally opt for a lower payment to achieve short-term financial goals, not to sustain an unaffordable lifestyle over the long haul. Here are some examples of borrowers who could successfully use an option arm. Recent graduates in high-paying fields like medicine can buy a nice house, make the minimum payment until the income kicks in, then play catch-up by making larger payments when they can afford to. Borrowers with good but sporadic income, like successful salespeople or owners of seasonal businesses, can pay more when flush and less when money is tight. Disadvantages. Borrowers who make extensive use of the minimum payment option could rapidly erode the equity of their homes and even end up owing more than the house is worth. For example, the 1% minimum payment on a $300,000 loan is $758.57 the first year, but if the loan's actual rate is 5.25%, it takes a payment of $1,312.50 to cover the interest owed. So borrowers who make the minimum payment will not be paying their mortgages down. Instead, the balance will increase each month, in this case by $553.63. Eventually, that money has to be repaid, and to accomplish this, the loan will be recast, possibly with very high payments, to make sure it is repaid within the 30-year term. Hybrid option arm. Hybrid option arms combine the features of traditional option arms with hybrid arms, offering fixed rates and payments for short or medium terms like a hybrid arm, supplying more predictability and safety to the borrower while retaining the flexibility of a traditional option arm. These loans generally feature slightly higher minimum interest rates, minimum payments, leaving less chance for insurmountable negative amortization. Their fixed rates are built-in safety nets for borrowers, making them a safer alternative to traditional option arms. Hybrid option arm. Hybrid option arms combine the features of traditional option arms with hybrid arms, offering fixed rates and payments for short or medium terms like a hybrid arm, supplying more predictability and safety to the borrower while retaining the flexibility of a traditional option arm. These loans generally feature slightly higher minimum interest rates, minimum payments, leaving less chance for insurmountable negative amortization. Their fixed rates are built-in safety nets for borrowers, making them a safer alternative to traditional option arms. These loans come in three varieties characterized by the following terms. 1. Initial fixed rate period. 2. The interest rate is fixed for the introductory period, after which it will adjust with market conditions, and be determined by an index plus a margin. 3. Initial fixed minimum payment period. 4. The minimum payment is fixed for an initial period, after which the minimum payment can change annually. The underlying rate moves with market conditions and is calculated by adding an index to a margin. 5. Initial fixed balance payment. Another possibility is an initial period in which both the rate and the minimum payment are fixed. This is the safest option. Most hybrid option arms are like choice number 3, or a combination of choices 1 and 2. For example, here is how a typical 3-1 option arm with a fixed rate and minimum payment works. For the first 3 years, the interest rate is fixed at 5.5%. The minimum payment might be fixed at 3 points below that, or 2.5%. So a borrower with a $300,000 mortgage might have the following payment options. Minimum payment at 2.5% equals $1,185 interest-only payment, at 5.5% equals $1,375 40-year payment, at 5.5% equals $1,547 30-year payment, at 5.5% equals $1,703 15-year payment, at 5.5% equals $2,451. Advantages. Like an option arm, a hybrid option arm allows borrowers to manage their mortgages by giving them a selection of payments in varying amounts to pay each month. The safeguards in the form of higher minimum payments and an introductory fixed interest rate can prevent borrowers from owing too high a balance at a time when their interest rate is adjusting upwards. The hybrid option arm can be thought of as an option arm with training wheels, offering both flexibility and safety. Disadvantages. Like all arms, there is a risk that the interest rate will adjust upwards when the introductory period ends. And if borrowers choose to avail themselves of the minimum rate for every payment, there will be deferred interest, negative amortization, although it will be less than with a traditional option arm. Graduated Payment Mortgages Loans, GPM, Negative Amortization Loan. These are mortgages on which the payment starts low and rises over time. Since the initial payment is used to qualify the borrower, the GPM may allow a borrower to qualify who would not qualify with a FRM. It is also known as a stepped rate loan or negative amortization loans. They offer adjusted payments at predetermined intervals. It is not an adjustable rate, it is a fixed rate of interest. For example, let's say that the mortgage payment on a $200,000 FRM for 30 years at 6% is $1,199. Stretched over 40 years, the payment would be $1,100. But the initial payment on a 30-year GPM at 6.5%, on which the payment rises by 7.5% a year for 5 years, is only $941. The interest rate on the GPM is fixed, just as it is on a standard FRM. The quid pro quo for the low initial payment is a larger payment later on. The payment on the GPM rises for 5 consecutive years, reaching $1,351 in month 61, or it stays for the remainder of the term. The initial payment on a GPM does not cover the interest. The difference, termed negative amortization, is added to the loan balance. In the example, the loan balance peaks at $202,905 in month 36 before it starts down. Not until month 61 does the balance fall below $200,000. This rising balance is a feature that lenders don't like, and it is why they charge a higher rate for GPMs than for FRMs. Advantages: GPMs have lower payments at the start of the mortgage to make it possible for more people to qualify for a mortgage. Payment increases are known ahead of time by the borrower and thus can be budgeted for. If the price of houses increases faster than the increase in the mortgage during the first years of the mortgage, the borrower will still see an increase in their equity. Disadvantages: GPM initial payments don't cover the interest due and the difference is added to the original amount borrowed. Negative amortization. During the initial 5 to 10 years, if your home hasn't increased in value, you can end up owing more than the house is worth. Also, if your income doesn't increase at the rate you anticipated, you may have trouble meeting the payments. The negative amortization inherent in this type of mortgage adds to the risk that a lender takes. The lender thus charges a higher interest rate on a graduated payment mortgage than they would on a fixed-rate mortgage. Other loan types. Besides GPMs, there are a couple of other alternative loan types. Bi-weekly loans. These loans will be paid every 2 weeks. This is most often used as a tactic to reduce the time that the loan has to mature because the principal is being paid down a lot faster than the normal once-a-month payment schedule. Interest-only loans. One of the more popular new mortgage products on the market is the interest-only mortgage loan. Interest-only loans are home mortgage loans in which only the interest is paid for the first 10 years. After that, the mortgage loan becomes fully amortized, which means you pay a monthly principal payment as well as the interest payment. Advantages: interest-only loans were designed to allow more people to get into the housing market. For example, a $400,000 first mortgage at a 6.25% interest rate has a principal and interest payment of $2,463 per month. The same interest rate of 6.25%, with an interest-only payment, is $2,083 per month, a $380 per month savings. This lower payment amount can help more borrowers qualify for a home loan, as well as allowing other homebuyers to purchase a more expensive house. Disadvantages: while the interest rate is fixed throughout the duration of the loan, the payment is not. After 10 years, your interest-only loan will become fully amortized, at which point you'll have 20, not 30, years to pay off your principal. Using our example above, after 10 years of mortgage payments, you still have a balance of $400,000. To pay the mortgage off in 20 years, the principal and interest payment demands $2,924 per month, almost $850 more than the original interest-only payment. This is manageable for some owners, but for other borrowers this is too much of a rate hike. Specialty loan types. There are still other scenarios that do not fit into the conventional lending criteria, so there are a lot of different types of specialty loans that can be offered to borrowers. Subprime loans. Generally speaking, a subprime mortgage is given to borrowers who are not considered prime borrowers, consumers that possess good credit and are offered the lowest interest rates available. Subprime loans come in many flavors. The most common are fixed for 2 years, the next most for 3. These loans also come in 30 and 40-year amortization periods, as well as interest-only. Interest-only subprime loans usually carry a higher rate for the fixed period because they are riskier loans, but the payment is lower. When these loans begin adjusting, they begin amortizing, which can make a sudden sizable difference in payments. When many subprime loans adjust, they do so every 6 months, which is one way to usually tell if you have a subprime. In comparison, A-paper hybrid ARMs almost always adjust once per year. Subprime loans also have 30, 40, and even 50-year fixed-rate loans, with some 30-year fixed rates only, having an interest-only option, usually carrying a quarter of a point higher interest and an interest-only period of 5 years. Be aware that a large percentage of these products are actually 30-year loans with a balloon payment at the end, but a balloon isn't relevant for most people who refinance. Subprime crisis. The subprime mortgage crisis came about when lenders started loaning money to anyone, regardless of their ability to repay the debt. After interest rates for many loans started to reset to substantially higher levels, thousands of borrowers were not able to make their payments. As a result of fears over the subprime mortgage crisis, lending requirements tightened up. In the past, consumers with credit scores under 550 were considered subprime, but that number has risen much closer to the 600 range, causing many consumers who are otherwise quite capable of paying for a mortgage to be declined. No income documentation, stated income loans. No income documentation, often called no-doc, loans require no employment, income, or assets to be stated on the borrower's loan application. Lenders do not verify any information beyond the borrower's credit profile and the value of the property. These loans can also be called light documentation, no income verification, quick qualifier, or QQ loans. These loans are available for single-family, townhouse, low-rise condos, and some manufactured housing. Availability. The availability of these loans varies with the strength of the economy and investor confidence. These high-risk loan types are harder to come by because of the subprime crisis, when this type of loan was abused. But with stricter guidelines now in place, no income documentation loans can still be obtained in the right circumstances. No-doc loan users. These loans are ideal for buyers who have income from sources that are hard to verify, like self-employed borrowers who have difficulty verifying all of their income, or by borrowers with very complex income structures. For instance, a borrower who has income from rental properties and investments may be hesitant to verify all sources of income due to the volumes of paperwork this would require. With a no-income documentation loan, the borrower simply states his or her income on the application, and the lender uses this stated income to qualify the loan. Lenders charge a higher rate of interest to help cover the additional risk on no-doc loans. Lenders do in fact verifying that the borrower has excellent credit along with assets that logically match the stated income. Down payments are typically higher, at 25% or more. Use only when necessary. Because no-doc loans carry a higher interest rate, they should only be used when the borrower has few other choices, and not to avoid the paperwork requirements of a full documentation loan. Balloon loans. Balloon programs are short-term loans, typically 5 or 7 years, that are amortized as if they were a 30-year fixed loan. After the short term expires, the remainder of the balance is due in one lump sum or balloon payment. A balloon mortgage offers an initial interest rate that is lower than fixed-rate mortgages. Monthly payments are low because the payments for those first 5 to 7 years are amortized at a low interest rate over the total length of the loan. If you plan on either selling your home, paying it off, or refinancing it before the balloon payment is due, then this type of mortgage is good deal. Most balloon borrowers refinance or sell their property before the balloon payment reaches maturity. No-cost purchases. This does not mean the home is free. It means there are no closing costs. This is available to some home buyers if the borrower's credit score, debt-to-income ratio, and other factors are strong, but the borrower has limited funds available for closing. This type of loan may also be considered when the interest rates are declining and the borrower wants to refinance quickly, though there is no way to predict the market and interest rates with much certainty. No closing cost loans can also free up more cash for the down payment or repairs. However, the closing costs are being rolled into the loan amount, meaning the closing costs are being financed, which increases the amount of interest the homeowner will pay over the life of the loan. Also, increasing the loan amount decreases the homeowner's equity. This is why this option is not considered standard. In some circumstances, however, it makes perfect sense. In some extreme cases, no closing cost loans can allow the homeowner to borrow more cash than is needed for the direct closing costs. As long as this does not exceed the lender's guidelines, typically 3% of the purchase price in overall credits, this cash can be applied to other costs in the transaction. Also, a no closing cost loan will not have points, so there is no deduction for that and other typical closing costs. Generally, points and some costs are deductible in the year you buy, even if the seller is paying for your points. Construction loans. These loans are short-term, usually 3 years, and are secured by a mortgage on the property being financed. They are meant to cover the cost of land development and building construction and are 1. Disbursed as needed, 2. As each stage is completed, 3. According to a prearranged schedule, or 4. When some condition is met. Funds are advanced at specific stages of construction, in so-called progress payments, with a portion held back until completion of the project. A certain percentage of the building has been leased or other criteria have been met. Construction loans are paid off from the proceeds of permanent financing, usually for 20 to 30 years, which in turn is repaid from the cash flow generated by the completed building and is arranged before the construction loan is disbursed. Also called building loan, construction mortgage, or development loan. Bridge loans. Bridge loans are designed to get you through a temporary mortgage transition period. Depending on your local real estate market, it often is advantageous to buy a home before selling the one you live in. Some of the situations in which bridge financing might make sense include: when the new home needs remodeling. This way you can work on the home without living through the dust and disruption. When homes sell fast in a coveted neighborhood. If you have your heart set on a particular neighborhood, then you may have to move fast to buy a home. Bridge loans do carry additional expenses, however. The interest rate on this type of financing often is 1 to 3 percentage points higher than traditional loans. Before using bridge financing, however, you need to do your research carefully and look at your income stream and ability to make the loan payments. Also, you should make sure your home is in tip-top condition and well-positioned to sell. Using home equity as bridge loan. If you have considerable equity in your home, one solution is to take out or use an existing home equity line of credit. This solution may not provide enough financing, however. New mortgage plus bridge loan. Another solution is to take out a new mortgage for the new home, plus a bridge loan that helps with the down payment and other expenses. The advantage of this option is that once you sell the home, you can use your equity from that home to pay off the bridge loan. Jumbo loans. Mortgage loans that over $417,000 are called jumbo or non-conforming home loans, while loans that are at or below $417,000 are called conforming home loans. Generally, jumbo loans cost 0.5% more in interest rates than conventional home loans. Some lenders have stricter qualification guidelines for jumbo home loans than for conventional loans as well. Should you need a home loan that is higher than the conforming loan limit, you will want to check with your mortgage advisor to see if a jumbo home loan is the best option. When the prime rate is low, a conforming loan combined with a home equity line of credit, HELOC, may actually be a cheaper and more flexible mortgage loan for you. Home equity loans and HELOCs. If you need to finance a large expense, a home equity loan might be the perfect solution. With its fixed payment schedule, low fixed interest rate, and potential tax advantages, it is a flexible mortgage option that can help you get the cash you need from your current home. Because the loan is secured by your home, the interest rate is generally much lower than for unsecured debt. There are many kinds of home equity loans, but the most common is a 30-year amortization with a 15-year balloon, although the 20-year fixed is almost as common. You need to refinance, sell, or pay the loan off prior to the end of 15 years, lest the lender call the note. Cashing out home equity with a home equity loan involves receiving cash for the entire loan amount and repaying it by making fixed equal monthly payments until the debt is retired. This makes the loan ideal for situations in which the entire amount will be needed at once, like debt consolidation or financing the down payment on a rental property. HELOC. Another way to use home equity is through the home equity line of credit, HELOC. A HELOC is a variable rate interest loan, usually prime plus a margin, and there is often an interest-only period. It is a line of credit, and so long as you stay within your credit limit, the initial underwriting covers it. Home equity lines of credit work differently. The borrower is granted a line of credit and can draw funds and repay them again and again. This is called revolving credit and is similar to most credit card accounts. These loans are ideal for recurrent expenses like college tuition or uncertain expenses like a long-term remodeling project or emergency funds for a new business. HELOCs feature variable rates, usually based on the prime rate, and a payment determined by the amount of credit used and the interest rate. As the prime rate increased in the last couple of years, so did the payment due on borrowers' HELOCs, and some borrowers were stuck with double the mortgage payment than the amount with which they started. To stop the rush of refinancing and to attract new mortgage loans, home equity lines of credit now offer optional pricing such as 5, 7, 10, 15, and 20-year fixed-rate locks on the home equity line. This allows the borrower to fix all or a portion of the line of credit to a set interest mortgage rate. For example, assume that you have $100,000 available line of credit and you need to borrow $30,000 against it. Nervous about interest rates rising but still desiring the interest-only mortgage payment available with a HELOC, you can now choose a fixed interest rate and a fixed loan term for the $30,000. If you decide to draw another $50,000 from your HELOC, you can fix that amount at the going rate as well. Technically, you can have a mortgage payment that reflects individual loan amounts set at different interest rates. Home equity loans and HELOCs. What to watch out for before converting unsecured debt to debt collateralized by your home. Be very sure that you can make your payments. While a credit card company can't do much if you default, your mortgage lender can foreclose and take your house if you can't pay. Also, homeowners should consider the implications of trading home equity for cash before taking a second mortgage. The lack of an equity cushion could make it difficult to sell the home should it become necessary. In addition, studies show that many homeowners who use their home equity to consolidate debt promptly run up their credit cards again, leaving them with no equity and more debt than before. However, homeowners who use their home equity wisely and keep a lid on expensive unsecured debt can really enhance their financial health. Piggyback mortgages. Piggyback loans have 100% financing with no money down. Of course, closing costs may still apply, and the interest costs are higher in this type of loan, but for those with little money saved up and who have a strong interest in home ownership, this option is available to those who qualify. These types of hybrid mortgages allow borrowers to close on two loans at the same time, a first mortgage and a second mortgage. Typically, the first mortgage is for 80% of the value of the property and the second loan is for 10 to 15% of the value. The remainder comes from your down payment. Piggyback loans allow you to get into a mortgage with a lower down payment. Avoid paying private mortgage insurance, PMI, in some cases. Possibly get a lower monthly mortgage payment than when taking out a loan with PMI. ARMs with a loan twist. Some hybrid loans are considered convertible ARMs because they include an option to convert to a fixed rate at a later date. These loans offer a measure of security, as you know the loan will become more convention in a certain number of years. A lower monthly mortgage payment initially. Before taking out this type of loan, consider whether any fees apply for converting to the fixed loan. Avoiding private mortgage insurance. If you purchase your home with less than 20% down, chances are you will obtain a loan that is insured by what is called private mortgage insurance, or PMI, which is generally required when a borrower has less than 20% equity in a home, i.e., the loan amount divided by the property value is 80.01% or greater. PMI protects a lender in the event of default on a loan. As your home appreciates or your loan balance decreases, or a combination of the two, and your equity in the home exceeds 20%, you may petition the mortgage holder to drop the PMI. This process may be cumbersome or difficult. 80-10-10 financing. One way to avoid paying PMI altogether is to purchase a home with a combination first and second mortgage. The first mortgage is limited to 80% of the home's appraised value, while the second mortgage, which closes in conjunction with the first, provides for the balance. In other words, if you have a 10% down payment available, your first loan would provide for the 80% mortgage with a second mortgage of 10%. This is commonly referred to as an 80-10-10 transaction. Self-insured programs. Another way to avoid paying for PMI is to find a lender that offers self-insured programs. This type of loan has a higher interest rate in place of the PMI premium. While mortgage insurance premium payments are not tax-deductible, the interest associated with a self-insured mortgage is fully tax-deductible. Whether you decide to get a loan with PMI or use one of the above two options depends on the total monthly payments of the various options, while taking into account the tax benefits of interest deductions. 100% financing. Loans that offer 100% financing let borrowers overcome one of the primary obstacles to buying a home: lack of a down payment. This loan is popular with first-time buyers, but it may also be available to seasoned homeowners, both on new homes or refinances. A 95% to 100% financed loan can be obtained on single-family residences, planned unit developments, duplexes, and condos. Some lenders will allow 6% seller-paid non-recurring closing costs to further assist the homebuyer. While they vary from lender to lender, here are some typical guidelines for obtaining a 100% financing loan. Minimum credit score of 600. Maximum 50% housing debt-to-income ratio. 3 lines of traditionally rated credit. Minimum 2-year credit history. Disadvantages. The largest disadvantage is that the borrower has no equity in the home. This can make it difficult on homeowners who find themselves unexpectedly needing to sell the home within the first few years after purchasing, especially if home values in the area begin to drop. FHA loans. The FHA mortgage loan was established in 1934 to help stabilize the real estate market and help more families achieve home ownership. The FHA offers a mortgage financing program that insures home loans. The FHA doesn't make the loans itself, rather, it serves as an insurance policy for lenders. Because the financial requirements for FHA loans are relaxed compared to traditional commercial loans, more people are able to afford to buy homes. Home buyers who wish to take advantage of falling housing prices but face credit issues, have little cash for a down payment, or are limited by their income may be able to finance their home with an FHA loan. FHA insurance makes lenders more willing to work with someone who might not completely fit their usual loan qualification requirements. FHA loans are available to legal residents of the United States with valid Social Security numbers who are of legal age to sign a contract. The maximum loan amount for an FHA mortgage is determined by the county in which the property is located. Visit the FHA webpage to find the limit for your area. FHA programs offered. The FHA offers many loans or grants. The location of the project and current economic situation of the area dictates what is available. These can include single-family residences, energy-efficient programs, Section 1 to 4 unit loans, disaster victim programs, rural housing programs, home equity conversion programs, reverse mortgage, condominium loans, manufactured home loans, manufactured lot loans, property improvement programs, foreclosure bailout programs, multi-family units, manufactured home parks. Rental housing loans low income, disabled, and elderly. Cooperative housing project loans. Urban renewal programs. Nursing home loans. Single room occupancy loans. Advantages. The chief advantages of an FHA loan are as follows. More generous income guidelines. Many lenders require a borrower's ratio of all payments, including the mortgage, divided by gross income. This is called a back-end or bottom ratio, to be 36% or lower. FHA underwriting allows back-end ratios of up to 45%. Higher loan-to-value limits. For those whose property values are stagnant or those with loans that have negative amortization features, being able to refinance up to 98.75% of their home's value is an amazing benefit. Lower debt-to-income ratios. FHA requirements reduce the debt-to-income ratio from 28:36, which is the traditional loan requirement, to 29:41 for FHA loans. We'll discuss how this ratio works a bit later. FHA loans also require a low down payment of 5% or less, and allow 100% of the money used for the down payment and closing costs to come from a family member, which is something that traditional loans won't allow. Higher cash-out LTV limits. Many conventional lenders allow cash-out mortgages at LTVs of 80 to 90%. FHA refinancing allows cash-out up to an 85 or 95% LTV, depending on borrower qualifications. FHA streamline refinancing. Homeowners who already have an FHA loan and want to refinance to a lower rate don't have to requalify for credit approval. And no appraisal is needed either. Streamline refinances are particularly advantageous for those whose credit ratings or home values have declined. Low down payment, less stringent credit requirements. FHA loans require only a low down payment requirement, as low as 3%, and the down payment doesn't have to come from the borrower. Also, credit qualification is less stringent than for conventional loans. For example, borrowers with past bankruptcies often must wait several years before being granted a conventional home loan. The FHA, however, requires only a 2-year wait, and sometimes only 12 months with extenuating circumstances. The FHA has no minimum credit score requirement. The borrower's credit is evaluated case by case. FHA finances fixer-upper purchases. With these homes, the mortgage is based on what the property will be worth on completion of repairs or rehabilitation. Disadvantages. The mortgage insurance premium paid on an FHA loan is always significantly higher than on a conventional program. For FHA loans, the borrower will be charged a mortgage insurance premium equal to 1.5% of the purchase price of the property and a renewal premium of 0.5% in subsequent years. By contrast, the mortgage insurance premium charged at closing on a conventional program is as low as 0.5%, with 10% down payment, with renewal rate in subsequent years as low as 0.3% in subsequent years. Example. Conventional mortgages that require PMI costs about $50 per month for every $100,000 of mortgage that you have. So if you had a $150,000, you would have to pay $75 a month for the insurance. Rural housing service loans. If you live in a rural area or small town, you may qualify for a low-interest loan through the Rural Housing Service, which offers both guaranteed loans through approved lenders and direct loans that are government-funded. These loans enable low-income families to get loans for homes. Reverse mortgages. Reverse mortgages pay you money as long as you live in your home. These loans are designed for people age 62 and older who own their homes and need cash. The loan is made against the equity in the home and isn't paid off until you sell or move out of your home. Until that time, the borrower receives regular payments prescribed by the terms of the loan. VA loans. Reverse mortgages are offered by state and local governments as well as banks and mortgage lenders. Shop carefully for these loans because interest rates and fees tend to be higher than in traditional mortgages. Ever since GI's return from World War II, the United States has had a tradition of giving military veterans a leg up in establishing themselves in civilian society. This tradition continues with the VA loan program, which is designed to help veterans and military service members obtain mortgages, often with better terms than they would have been able to get otherwise. When the housing market is slumping and fewer prospective buyers qualify for mortgages under stiffened lending standards, the VA loan program should help bolster housing demand. Who is eligible? All veterans who are in the service, or have served and were released with an honorable discharge, are eligible. Applications involving other than honorable discharges will usually require further development by VA to determine if the service was under other than honorable conditions. Wartime service. You must have at least 90 days on active duty and been discharged under other than dishonorable conditions. If you serve less than 90 days, you may be eligible if discharged for a service-connected disability. Peacetime service. You must have served at least 181 days of continuous active duty and been discharged under other than dishonorable conditions. If you serve less than 181 days, you may be eligible if discharged for a service-connected disability. What the VA loan program does. The VA loan program guarantees a portion of a mortgage made to a qualified veteran or service member. As with FHA loans, the VA itself does not make the loan, but they guarantee a portion of the loan. The VA allows lenders, including banks, savings and loan associations, and mortgage companies, to offer the following: credit to borrowers who otherwise might not qualify, interest rates which may be lower than for non-guaranteed loans, mortgages with little or no money down, applied directly to lender. Borrowers apply to a lender, and then the VA guarantee becomes effective when the loan is closed. Borrowers shop around. Because VA loans are freely available in the marketplace, rather than through a single provider, borrowers can shop around to obtain the best terms. Certificate of eligibility. VA loans are designed to cover a wide variety of situations, which is good for eligible borrowers, but can make the eligibility requirements confusing. However, prospective borrowers can find out in advance if they are qualified by obtaining a certificate of eligibility from the Veterans Administration. Also, most lenders now have access to an automated system which can determine eligibility. Advantages. VA loans do some things better than conventional or FHA loans, so veterans should look at the pros and cons of each program before choosing. Here are the pros of VA financing. No down payment required. The main advantage of the VA loan is that no down payment is required. Buyers can finance 100% of the purchase price up to $417,000. Even the funding fee of 2.2% can be financed into the loan, so borrowers need not come up with money out of pocket. Super maximum mortgages available. So-called super maximum VA mortgages of up to $1 million are available, although a down payment is required for any amount exceeding $417,000. For these loans, borrowers need to come up with 25% of the loan amount. For example, a $600,000 house would require no down payment on the first $417,000, and a 25% down payment on the remaining $183,000. The resulting down payment of $45,750 is still only 7.63% of the entire amount, very generous terms when compared to conventional financing. Underwriting guidelines less restrictive. Underwriting guidelines are less restrictive than for conventional mortgages. VA loans can be applied for 2 years after a bankruptcy or foreclosure. Income also goes further with a VA loan, as a back-end ratio, total of all payments including the mortgage gross income, of 41% is deemed acceptable. Many conventional lenders prefer not to approve loans when the back-end ratio exceeds 36%. Streamlined refinances. VA refinances can be streamlined just like FHA loans, with no credit check or appraisal needed. No monthly mortgage insurance required. There is no monthly mortgage insurance required, and closing costs the buyer pays are limited by law. Assumable. VA loans are assumable, which can make it easier to sell a home. Borrower's assistance. VA can also provide assistance to borrowers with temporary financial problems and in danger of foreclosure. GPMs available. In addition to traditional 30-year fixed-rate mortgages, borrowers can opt for a graduated payment mortgage, or GPM. This provides low initial payments, which gradually rise to a fully amortizing payment in the 6th year. Other options include growing equity mortgages, or GEMs, which gradually increase payments and apply all of the increase to the principal to accelerate mortgage payoff. Loans multi-use. VA loans can be used to build a home, improve a home, or buy a manufactured home and lot. Disadvantages. Most of the disadvantages of VA financing don't apply to many borrowers. However, veterans considering VA and other options should be aware of potential pitfalls in financing with a VA mortgage. Loan amount. Zero-down loans are limited to $417,000. In higher-cost areas, this could prove restrictive. Funding fee. The VA upfront funding fee is 2.2%, which covers the mortgage insurance for the life of the loan. This could prove expensive if the borrower doesn't keep the home for at least a few years. Active duty military personnel may get transferred frequently. Paying 2.2% every time they buy a house might not make sense. In this case, FHA or conventional financing might be a better deal. Refinances limited. Refinances are limited to 90% of the home's value, even if the refinance is a streamline from one VA to another. VA loan types. VA, Veterans Administration, commonly offers these types of loan programs. They are 30-year fixed rate, 15-year fixed rate, 2-to-1 fixed rate buy down, interest rate reduction refinance IRRR, refinance of existing VA, construction loans, manufactured home loans, rehab loans, VA foreclosure home loans, vendee financing, VA vendee financing. Unlike VA loans, which are guaranteed by the VA and are only granted to U.S. veterans and their spouses, VA vendee financing is available to veterans and non-veterans, as well as owner-occupants and investors, to buy VA home foreclosures. Under this program, the VA sells vendee financing loans to national lenders. VA vendee financing is not available on all VA repossessed homes, however, so check the VA homes list for the availability of VA vendee financing on a particular VA home foreclosure. There is no limit on the number of VA foreclosure homes you can buy with VA vendee financing, but you can only have 5 active loans within a 6-month period. Community home buyer programs. Community home buyer programs are designed to assist communities in redeveloping residential areas and in providing reasonably priced homeownership opportunities for those with limited income, credit, or down payment. Community home buyer programs offer financial counseling and education and mortgage loan options to help homebuyers get into a new house. Many mortgage lenders offer products in conjunction with various community initiatives to increase homeownership. Typically, future homeowners are required to attend a course that covers the basics of homeownership, including how mortgage loans work, organizing finances and establishing a household budget, making responsible financial decisions and avoiding future bad credit, understanding credit scores and how to improve a bad credit score, debt counseling and creditor repayment, costs of owning a home. These programs may also offer low-interest loans, down payment matching, or down payment assistance. Some loans require as little as 1% down, or feature a mortgage tax credit certificate program, which reduces the federal income taxes of qualified borrowers. Completing a program has been shown to improve a borrower's chance of making home ownership a success. Fannie Mae and Freddie Mac. Mortgages made by banks and other lenders are typically sold on the secondary market in order to produce cash so the lenders can make more mortgages. The more mortgages a lender makes, the more money it makes because most of its income comes from fees, points, and other charges associated with the loan. The largest purchasers of mortgages on the secondary market are the government-sponsored enterprises, GSEs. The Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. These large enterprises were created by congressional charters in order to make mortgages available to more people with low and moderate incomes. They became private companies but recently came again under federal oversight. Both Freddie Mac and Fannie Mae have specific requirements for loan products that banks and lenders have to comply with if they want to sell the loan on the secondary market. They purchase mortgages from lenders and then sell them as securities in the bond market. This provides lenders with the money to make more mortgages. These mortgage-backed securities, MBS, offer investors a good return. Loan limits. The loan limit for both Freddie Mac and Fannie Mae loans for single-family homes in the United States defines the boundary between conventional and jumbo loans. These limits change annually based on the single-family home price survey done by the Federal Housing Finance Board in October. Legal issues. Often borrowers go in to sign mortgage loan documents and find their mortgage loan is not the one they negotiated. Suddenly there are origination fees, prepayment penalties, higher interest rates, or loan payment terms different than what had been discussed. In order to prevent surprises in your home loan, and to compare lenders and mortgage products, always ask your lender for two key documents: the Mortgage Loan Disclosure Statement, MLDS, and the Truth in Lending Disclosure Statement. Truth in Lending Disclosure Statement, TILD. Truth in lending laws were passed by Congress in 1969 as part of the Consumer Credit Protection Act and ensure that consumers make informed decisions regarding extensions of credit. While creditors are required to disclose certain information, it's still the consumer's responsibility to research creditors and credit terms. They require anyone who extends credit to a consumer to disclose the following: how finance charges were computed, annual percentage rate, total finance charge over the life of the loan, payment schedule and total number of payments that will be made over the life of the loan, prepayment penalties, if any, late payment terms. If you have an adjustable rate mortgage, ARM, the lender must disclose the maximum interest rate that can be charged, when and how finance charges are imposed. These things must be disclosed up front, in writing, and in terms that are easy to understand. In addition, the real estate section of the Truth in Lending Act gives consumers something called a right of rescission on refinancing and line of credit transactions. This means that you have 3 business days, from the date you sign the agreement, to back out of a loan, no questions asked, and the lender cannot charge you any kind of cancellation fee. Real Estate Settlement Procedures Act. Adopted in 1974, the Real Estate Settlement Procedures Act, RESPA, is another consumer protection law. It covers purchase loans, assumptions, refinance loans, property improvement loans, and equity lines of credit for 1 to 4 unit residential properties. RESPA serves 2 functions. It requires certain disclosures to borrowers and it prohibits certain practices that can drive up the closing costs of a loan. Good Faith Estimate, GFE, or Mortgage Loan Disclosure Statement. Your lender is required by the Federal Real Estate Settlement Procedures Act to provide you with a GFE within 3 days of applying for a loan. The GFE contains closing fees, also called settlement costs, cover almost every expense associated with your home loan. Because closing costs typically amount to between 3% and 5% of the sale price, it is best to wait until you receive the GFE before committing to a loan. Smart loan shoppers obtain GFEs from 2 or more lenders, compare their costs, and ask questions about any large discrepancies. Here's a list of some of the fees you'll find on your GFE. Disclosures before closing. Here are some disclosures that occur before closing. A special consumer information booklet, for purchase transactions only. An affiliated business arrangement, AFBA. Any relationship between the lender and any other party providing services in relation to the loan. HUD-1 settlement statement. Disclosures at closing. Here are some disclosures that occur at closing. A HUD-1 settlement statement. An initial escrow statement. Disclosures after closing. An annual escrow statement. A servicing transfer statement. Transferring servicing. If the loan servicing is transferred, RESPA also provides further consumer protection by prohibiting kickbacks, fee splitting, unearned fees in return for referrals for settlement services. RESPA also prohibits the seller from requiring the use of a certain title insurance company, and it places limits on escrow accounts. Various federal housing acts. The following federal housing acts have been passed over the years, helping to guarantee fairness and openness to the home buying and development process. Equal Credit Opportunity Act. This act prohibits credit discrimination on the basis of sex, race, marital status, religion, national origin, age, or receipt of public assistance. Home Mortgage Disclosure Act. This act requires that lenders report public loan data on both approved and denied loans. Community Reinvestment Act. This act encourages insured depository institutions to help meet the credit needs of the communities in which they serve, including low and moderate income neighborhoods. Fair Housing Act. This act prohibits discrimination in any housing-related transactions based upon race, color, sex, religion, national origin, familial status, or handicap. Fair Credit Reporting Act. This act is designed to promote accuracy and ensure the privacy of the consumer credit information from consumer reporting agencies such as credit bureaus. New Homeowners Protection Act. Also known as the PMI Act, this act establishes rights for homeowners with mortgages obtained on or after July 29, 1999, regarding private mortgage insurance, PMI, cancellation. Fair Debt Collection Practices Act. This act requires that debt collectors treat borrowers fairly by prohibiting certain methods of debt collection. It prohibits unfair, deceptive, or abusive practices, including overcharging, harassment. It also prohibits disclosing consumers' debt information to third parties. Gramm-Leach-Bliley Act. This act protects consumers' personal financial information. It requires financial institutions to give their customers privacy notices that explain their information collection and sharing practices, gives customers the right to limit some sharing of their information, requires financial institutions to have a security plan to protect the confidentiality and integrity of personal consumer information, and prohibits the use of false pretenses to obtain a consumer's personal financial information. Patriot Act requirements. The Patriot Act was designed to help keep track of suspected terrorists and requires any suspicious financial transaction to be reported to the federal government. In a mortgage transaction, the information identifying each borrower, such as names and social security numbers, must be reported. If you have doubts about the information that your lender is requesting from you, verify it by referring to the federal government website, or talk to your lender, preferably a supervisor, and asking if the information is required by law. Refinancing. Refinancing is simply taking out a new mortgage. If you are considering refinancing your loan, your first steps need to determine your short and long-term goals and then evaluating the refinance options available. Reasons to refinance. Here are some reasons to refinance an investment property or even your own personal residence. Lower your interest rate monthly payment. By refinancing your mortgage, you can lower your interest rate and, as a result, your monthly payment. Get cash out of your house. By refinancing, you can capitalize your equity just like your checking account. Refinancing can be a great way to get cash out of your house and into your pocket. Consolidate debt and simplify your life. Having multiple loans can sometimes be a burden. Refinancing allows you to consolidate all your loans and pay your debt with one easy payment at a lower interest rate. Credit score has improved. If your credit score has recently improved, you may be eligible for a lower interest rate on your mortgage. Refinance today and lower your rate. Stop payments from rising. If you are in an arm that is about to adjust upwards, refinancing can stop the rising payments. Lock in your monthly rate and payment and get peace of mind. Loan options. Here are some loan options to consider when you refinance. Cash out refinancing or home equity loan. Property owners needing immediate cash may wish to negotiate a cash out refinancing loan from mortgage lenders. Unlike a home equity loan, which involves adding an additional loan to your existing mortgage, the cash out refinancing loan pays off the original home loan and then some. For example, a homeowner with a $120,000 balance against an initial $225,000 mortgage may be able to obtain a $165,000 cash-out refinancing loan. From the new loan, the homeowner can apply $120,000 to retire the original mortgage and then pocket $45,000 for personal use. To do so, the borrower has traded $120,000 of debt remaining in the old loan for $165,000 of debt in a newer, lower interest rate loan. Only use cash out if it's the best option. Financial advisors remind homeowners that with a cash-out refinancing loan they'll get cash from the transaction but will have to pay up to several $1,000s in closing costs. This transaction can be worth it if the drop in rate from the original loan to the new loan is significant, but it may be wise to examine other options, including a home equity loan, which also delivers cash out but which leaves the original loan in place. Use cash-out money for renovation. While not required, it's considered a prudent gesture for those who decide on a cash-out refinancing plan to invest some of the money back into the property through a remodel, renovation, or home addition. Cash-out effect on equity. Finally, the homeowner should consider the effect the cash-out amount will have on their home equity. It is good to retain some equity in the home, especially if there is a possibility you may need to sell the home before equity can be re-established. Homeowners should retain at least enough home equity to pay for the cost of selling a home, even if home values drop and they are forced to sell for less than the home was worth when the refinancing took place. Low fixed rate loan. If you currently have a high fixed rate mortgage and the rates have dropped due to market conditions, then you may want to refinance to a low fixed rate loan. Also, if you have an ARM, you might consider this option in order to get the security of a fixed rate. Even if your adjustable rate is low now, it is not guaranteed to remain that way, but if you get a low fixed-rate loan, then you lock that low rate in for the life of the loan. This option is a good choice if you are not planning on moving within the next 5 years. Shorter-term loan. If you need to build up equity quickly and pay off your mortgage sooner, then refinancing to a shorter-term loan is your best choice. A lot of times, if you refinance to this type of loan, your monthly payments will be higher, but you will pay substantially less interest and your mortgage will be paid off sooner. Also, you would benefit from a larger tax deduction on interest if you move from a 30-year fixed to a 15-year fixed loan. There may be some cases where you can refinance to a shorter-term loan without raising your monthly payment if you've had your current mortgage for enough years. Longer-term loan. If your current monthly payments are higher than is comfortable for your financial situation, then you may want to refinancing to a longer-term loan. This will result in a decrease in your monthly payments, since you will have more time to repay the loan. Jumbo loan refinancing. Let's take the mumbo jumbo out of the jumbo loan refinancing package. As you may recall, a jumbo loan is a mortgage with a total that exceeds conforming loan limits. Homeowners sometimes refinance to jumbo loans to boost buying power or retire mortgages that no longer suit their goals. The relatively high risk of defaults associated with jumbo loan refinancing means that lenders will probably charge higher interest rates. Closing costs higher. Closing costs for jumbo loan refinancing packages also can be comparatively high. Speak with a variety of lenders to find whether a jumbo loan is for you, or if you'd benefit from a more conventional second mortgage in combination with other options including debt consolidation. No-cost loans. Any loan where the lender pays all of your closing costs, title and escrow fees, appraisal, lender's fees, etc., is called a no-cost loan. With a no-cost loan, you can refinance for any incremental drop in your interest rate since the transaction costs are zero. Even in a declining rate market, where you believe rates may continue to fall, a no-cost loan makes sense. Should rates continue to decrease, you will have invested nothing in the loan costs and can simply refinance at any time. Some borrowers refinance every year or less. For example, on a loan of $200,000, a borrower can be quoted 6.75% with 0.875% points, 7% with 0 points, or 7.25% with no closing costs. All three of these quotes are for a 30-year fixed-rate mortgage. The borrower can select the combination which feels most comfortable to their personal situation. For some borrowers, the no closing cost option of 7.25%, while providing a slightly higher rate, still requires the least investment upfront and therefore is the best option. No-cost loans will always carry a slightly higher rate than a loan that does not pay your costs. A no-cost loan is the better strategy if you plan to keep your loan only for the next 2.5 to 3 years. If you plan on keeping your house longer than that, you should consider paying closing costs to get a lower rate because the lower rate will save you more money over time despite the money spent on closing costs. Action items. Review the traditional loan application process and determine if this is a financing option for you for your investment properties. If it is not, is it an option for you to refinance your existing home or for you to acquire your own home? Pull and review your tri-merge credit report and score and rectify any errors that you might find on it with the credit bureau. Go back to your lenders list created in the financing lesson and revisit these lenders to find out what loan options might currently be available to you on your investment properties. Find at least 10 motivated sellers, narrow down to 5 properties of interest, and submit offers contingent on securing a loan. If you find a loan program you like and think you will qualify for, prepare and submit all the appropriate documents to your lender for a pre-approval. Summary. Traditional loans may not always be feasible for everyone. If you have bad credit or a high debt-to-income ratio, you may not qualify. Luckily, there are many more options in the creative financing world that might be better suited and can even be done faster than in the traditional lending world. The information we provided within this guide was to help you learn what options you have with traditional loan products and how your credit or your money partner's credit is affected. It is always best to know all of your options, even if it is just to refinance your existing home or acquire your own first home. Finally, this module lesson can be helpful when you are trying to help a buyer become educated enough about financing so they can take the right steps and qualify for the best financing for their situation.